The echoes of a real estate earthquake are getting louder, and it's not just the walls that are shaking. A huge $1.4 trillion wave of debt heading for the housing market. It's like a huge bill that everyone has to pay, and it's getting out of control. Warren Buffett, who's probably one of the greatest investors of our time, has warned us about the upcoming collapse in real estate. The 15-year buildup. Low interest rates mean that borrowing money is cheap. It's like getting a loan with a really good discount. When borrowing is cheap, people are more likely to take out loans to buy things like houses. Now, when lots of people are borrowing money to buy houses, there's more demand for houses. That's like the most basic way of how real estate in general functions. High demand tends to drive up prices. So, the combo of cheap loans and lots of people wanting houses can make real estate prices go up, sometimes higher than they should be. This is what happened when low interest rates led to a bunch of debt, and that debt fueled a real estate boom. But remember that it is the debt which fueled the boom. Debt-fueled real estate investment. A practical example. Let's make it a bit more personal. Imagine you, as an individual, want to invest in real estate by buying an office building. However, the cost is beyond what you currently have in your savings, so you decide to take out a loan to make the purchase. You approach a bank or a lending institution and secure a loan for a significant portion of the office building's purchase price. This loan is essentially a financial tool that allows you to leverage the bank's money to make the investment. While the loan covers most of the cost, you're usually required to make a down payment, which is a percentage of the property's value. This demonstrates your commitment to the investment and also reduces the risk for the lender. Equity in action. Now, let's talk about equity. Equity is the portion of the property that you actually own outright. In our example, it's the value of the office building minus the outstanding loan amount. Appreciation and building equity. Over time, if the value of the office building increases due to factors like market demand or improvements you make, the equity in your investment grows. This is because the building's value minus the remaining loan amount is now larger. Rental income boosting equity. If you decide to rent out office spaces in the building, the rental income can be used to pay off the loan. As you pay down the loan, your equity increases and you own a larger share of the property. Selling for profit. If you eventually decide to sell the office building, the proceeds from the sale will first go to paying off the remaining loan. The rest is the profit, representing the addition of your equity growth over time. Understanding equity. Equity definition. Equity is essentially ownership. In the context of real estate, it's the value of the property that you truly own, free and clear of any debts. Equity calculation. It's calculated by subtracting the outstanding loan amount from the property's current market value. As the loan decreases through payments and the property value increases, your equity grows. Role in purchasing. Initially, your down payment contributes to your equity. As you pay off the loan and the property appreciates, your equity increases, making real estate investment not just a financial transaction, but a wealth-building strategy over time. The impact of interest rates on real estate. Reliance on interest rates. Real estate buyers heavily depend on interest rates, and slight fluctuations can significantly affect the profitability of their purchases. When interest rates are low, borrowing money is cheaper, incentivizing buyers to take out larger loans and increasing demand for real estate. Affordability and demand. Low interest rates enhance affordability, making homeownership more accessible. Lower monthly mortgage payments encourage individuals to invest in properties, not only driving individual purchasing decisions, but also boosting overall demand in the real estate market. Effect on profitability. Low interest rates can enhance the profitability of real estate investments. With lower borrowing costs, investors can achieve higher returns on their investment, especially if the property's value appreciates over time. Vulnerability to interest rate increases. However, the real estate market is highly sensitive to even slight increases in interest rates. Rising rates make borrowing more expensive, potentially decreasing demand as buyers find it more challenging to afford loans. thus slowing down the market. Impact on property values. Rising interest rates can put downward pressure on property values as buyers may be less willing or able to pay high prices for real estate. This can lead to a correction in property values, affecting the profitability of existing investments. Adjustable rate mortgages, or ARMS. Buyers using adjustable rate mortgages are particularly vulnerable to interest rate fluctuations. If rates rise, monthly payments can surge, putting financial strain on homeowners and potentially leading to difficulties in meeting mortgage obligations. Investor strategy shifts. Investors may adjust their strategies based on interest rate movements. In a low interest rate environment, they might be more inclined to leverage their investments with loans. Conversely, in a rising rate environment, they may prioritize less leveraged or different types of investments. In essence, the real estate market is intricately tied to interest rates, and monitoring these trends is crucial for both individual buyers and investors navigating the complexities of real estate transactions. Commercial real estate concerns, Munger and Buffett's perspective. Ownership disparity. Charlie Munger, Warren Buffett's longtime business partner, has expressed growing concerns about commercial real estate, suggesting that a storm is brewing in the sector that could have far-reaching effects, potentially impacting banks and the broader market. Munger emphasized a notable aspect: the buildings don't go away, but the owners do. Not just that, he foresees a significant and unpleasant impact on downtown areas in the United States and globally. He anticipates a hollowing out as the landscape of commercial real estate undergoes a transformation, leading to a different set of owners in the future. Challenges in metropolitan areas. Buffett and Munger's worries may stem from McKinsey's report, revealing that foot traffic near stores in metropolitan areas is still 10% to 20% below pre-pandemic levels. Moreover, office attendance remains 30% lower than before COVID-19. This decline in demand for office space could persist, with McKinsey predicting it to be almost 20% lower in 2030 compared to 2019. Remote work impact. The rise of remote work is a key factor contributing to these concerns. Around 28% of paid workdays were work from home in October 2023, according to WFH research. This shift poses challenges for commercial landlords, and Munger highlights that the U.S. banking sector may face difficulties due to what he perceives as bad loans in the commercial real estate sector. Risk of underwater loans. Munger's fears point to a potential scenario where higher interest rates, lower rental income, and decreasing property values could lead to some loans in the commercial real estate sector going underwater. This means that the outstanding balance of these loans would exceed the value of the underlying properties. Investment strategy. While Munger and Buffett express concerns, they seem cautious about venturing into commercial real estate, stating that Berkshire Hathaway has not been active in this sector. Munger notes that it might work better for taxable investors than for corporations taxed the way Berkshire is. Instead, the billionaire duo seems to be eyeing opportunities in other segments of the real estate market, highlighting a potential shift in their investment focus. Berkshire Hathaway's pivot to residential property development. Strategic shift. In a notable strategic shift, Berkshire Hathaway, led by Warren Buffett and Charlie Munger, has veered away from commercial real estate concerns and shifted its focus towards residential property development. This move includes substantial investments in prominent home builders, indicating a strategic bet on the potential boom in the housing market. Home builder stakes. Berkshire Hathaway's portfolio now boasts significant positions in key home building companies such as D.R. Horton, Lennar, and NVR. These stakes position the conglomerate to capitalize on the anticipated growth in the residential real estate sector. Housing shortage dynamics. The National Association of Realtors reports a housing shortage ranging from 5.5 to 6.8 million units. This shortage has been exacerbated over the past decade as more households formed than homes built, a trend dating back to the aftermath of the Great Financial Crisis. With lower lumber prices and sustained demand, investors are optimistic about the prospects of a housing boom. Investor opportunities. This potential housing boom is not exclusive to major conglomerates. Retail investors can also participate in this sector through publicly listed homebuilders or exchange-traded funds, or ETFs, like the S&P SPDR Homebuilder ETF, or XHB. These investment avenues provide a way for individual investors to tap into the expected growth in residential real estate without directly engaging in property development. As Berkshire Hathaway strategically navigates away from commercial real estate vulnerabilities, its focus on residential property development aligns with the prevailing trends in the housing market. The housing shortage, coupled with favorable market conditions, positions the conglomerate and individual investors to potentially benefit from the anticipated boom in the residential real estate sector.